You walk into a bank, hand over your paycheck, and they smile and say, "Thank you." But what happens next might surprise you. Because the moment your money hits that account, the bank is already putting it to work. Not for you, for them. Banks are, at their core, middlemen. They take your deposit and pay you a small interest rate for the privilege of holding it. Right now, the average savings account pays around 1%, sometimes even less. That is what your money earns just sitting there. But here is the catch. The bank takes that same deposit and lends it out to someone else at a much higher rate. Mortgages, car loans, business credit lines, these all carry interest rates between 5 and 7%, sometimes more. Wilde ineligible comprendly live. That gap between what the bank pays you and what it charges borrowers is called the net interest margin. It is their bread and butter. Think about it. They pay you 1%, charge someone else 6%, and pocket the 5% difference on your money. Multiply that spread across millions of accounts and billions of dollars, and you start to see why banking is so profitable. Multiply that spread across millions of accounts and billions of dollars, and you start to see why banking is so profitable. In 2023 alone, the largest US banks earned over $200 billion in net interest income. That is your money working for them. But the interest spread is only part of the story. Banks have another massive revenue stream, and it comes directly from your pocket. Fees. Overdraft fees alone generated billions of dollars in revenue for banks last year. One small mistake and you are paying $35. Your account dips below zero by just a few cents, and the bank charges you more than what most people earn in an hour. Then there are ATM fees. Use a machine outside your bank's network, and you can pay $3 to $5 just to access your own money. Monthly maintenance fees, minimum balance fees, paper statement fees. Banks have turned the simple act of holding your money into a revenue machine. Credit card fees are another goldmine. Late payment charges, annual fees, foreign transaction fees. Every swipe is a chance for the bank to earn. And do not forget interchange fees. Every time you tap your card at a store, the bank takes a small cut of that transaction from the merchant. All of these fees together make up what is called non-interest income. For the biggest banks, it accounts for nearly half their total revenue. Now here is where it gets really interesting. Your money is not actually sitting in a vault with your name on it. Banks operate under something called fractional reserve banking. They are only required to keep a fraction of your deposits on hand. In the United States, that reserve requirement has historically been around 10%. During the pandemic, it was dropped to zero. That means for every $100 you deposit, the bank can lend out $90 or even more to other borrowers. Your savings are not idle. Right now, they could be funding a stranger's home purchase, a small business loan, or someone's car payment. The bank keeps a thin cushion of reserves and puts the rest to work, earning interest on money that technically still belongs to you. If too many people tried to withdraw their deposits at once, the bank would not have enough cash. That is called a bank run. It is the fundamental vulnerability of fractional reserve banking, and it is why deposit insurance and central banks exist as safety nets. So the next time you check your balance and see your money sitting there, remember, it is not really sitting anywhere. It is out in the world, earning returns for the bank while you collect a fraction of a percent. Your money never sleeps. It just works for someone else.